Hello, welcome to the Week in Markets. I'm pleasure to be joined by Matt Henderson and Portfolio Manager. I suppose, Matt, there's been a lot to digest for markets this week, and there's a lot coming up next week. Think about the US election and also various central bank meetings. However, this week it's all been about the UK budget, corporate earnings, as well as a number of economic data points coming predominantly from the US. So a lot to get into today. I suppose let's start with the UK budget, where we've had, we've already done a podcast and other videos on this subject. So please dial into those for more details around the UK budget specifically. But perhaps thinking about the market reaction, initially pretty good, but then a bit more volatility. Do you want to talk us through that?
Yeah, so I think in summary, as you said, we're not really going to touch on the actual implementation that we're going to see from the back of the budget, but what we have seen and what we know is coming through is we're going to need additional borrowing from the government to fund those plans, and that will come in the form of extra gilt issuance. So as you said, going into the budget, maybe markets had got themselves a little bit ahead of themselves thinking about worst case scenarios. So on the day we actually saw gilt yields come in, but once the plans were actually announced and the market had an idea in terms of the amount of gilt issuance that was going to come through and how that extra supply would affect yields, we actually saw them move out over the day. So although on the day they actually only closed up about 4 or 5 basis points higher, there's probably about over the day 20 basis points worth of movement. So actually quite a lot of volatility in gilts. The day after they were also higher. So over the week we're about 17 basis points higher in terms of gilt yields just from the budget announcement.
I suppose the problem is for the markets is that growth isn't going to be pushed materially higher. If not, over the next 5 years it could end up actually slightly lower, and there's just going to be even more borrowing needed, and therefore more UK gilt issuance. Market's got to digest that issuance, so it pushes yields higher. So yeah, a bit of volatility, but we have seen yields settle down. Certainly today, Friday afternoon, yields have come to around 4.4%. So that's pleasing, and we've also seen sterling rally a little bit today, as well as UK equities.
Yeah, so I think with the budget, the main asset class or market it's affected in the UK has been the fixed income market. We haven't really seen too many moves on the currency front, and equities haven't really been that broadly impacted by the budget announcement. It's mostly bonds.
Yeah, super. So if we turn to corporate earnings, so we're going through what they call earnings season, where corporates announce their earnings for the quarter that's just gone, so Q3. A lot of attention is, how corporates deliver on earnings, revenues relative to the analysts' expectations, but just as important is what the management teams say about their future expectations for their business, but also for wider economic trends. I suppose the focus for this week has been all about US technology stocks. I suppose we've seen exceptional returns from some of the technology stocks this year. Someone like Meta's up 67% before the earnings came through. I suppose we've got lofty valuations, lofty growth expectations. So how have some of the companies delivered?
Yeah, so we're most of the way through earnings season at the minute. We've had in the S&P 500 about 350 of those companies report, so more than half have reported. When we look at the numbers that we can see, so we can see those businesses report on revenue growth, and they'll also report on earnings growth. So when we look at revenues, about 52% of companies have beat analyst expectations, so a bit more mixed there on the revenue front. On the earnings front, we're about 75% of those companies beat, so a lot more positive on that front. I guess, like you've said, we've seen more announcement from the tech sector, and actually in some of the forward guidance where some of the market has been questioning what those companies are doing, I guess what we are seeing is companies like Meta that you mentioned earlier, they're looking to invest more into AI capabilities, so more money being deployed into that area. And I guess what the market is somewhat questioning, I guess, is that those areas are yet to actually be profitable for those businesses. So something like Meta, a lot of the revenue comes from the advertisement part of the firm. So I think the market's trying to get a handle on, in the future, how profitable will AI be versus what we actually already know to be profitable in their advertising part of the business.
Yeah, I suppose a lot of hope and promise there, and enthusiasm, and share prices have already reacted this year, but they really need to deliver on the earnings side over the not next 12 months, but several years into the future. So we saw some weakness, I suppose, initially from the major US tech companies. So I think Meta was down 4% after its results. Yeah. Microsoft was down 6%. So a bit of weakness, but in the context of what they've already delivered, it's quite minor. I suppose looking ahead next week, obviously we have the US election. We've got the Federal Reserve, the US Central Bank meeting on Thursday, where there'll be a decision on whether they change interest rates. In September, they cut by 0.5%. They are expected to cut by 0.25% on Thursday. The US election shouldn't have an impact, but there may be a bit of caution from central banks. I suppose just reflecting on the economic data that we've had this week, we've had a huge wave of economic data from GDP to inflation to jobs data. Can you bring it all together for us, Matt?
Yeah, so, as you said at the start of the video, most of this has actually been predominantly from the US. So if we look at GDP, that came in at 2.8% for quarter three. That was, thereabouts in terms of expectation. So still seeing pretty strong growth from the US. That means if it can continue to deliver on that growth path, it'll actually exceed what the Fed's own expectation of growth was in the US, and that's maybe why we've seen some of the interest rate expectations be priced out. Inflation, once again, story's still pretty positive for markets and for the Fed. We're in that 2 to 3% region, nowhere near where we had been over 2022. We've just this afternoon, about half an hour ago from filming, had the US job report. That was maybe a bit more questionable, but in terms of the strength of the data, but we have had things that have occurred which maybe make that data point a bit null and void, where we've had strikes and poor weather. Yeah,
so just specifically what you're talking about is the number of jobs added to the US economy in the month of October was much weaker than initially thought. So I think there was about 100,000 jobs were expected. It was more like 12,000 jobs expected, but bring out a really critical point is that because you've had hurricanes where companies have had to shut down, manufacturing shut down, but also you've had various strikes at the likes of Boeing, that's going to have a big impact potentially on some of this data, and it can be quite noisy, really. So I suppose thinking to the Federal Reserve meeting next Thursday, they might, acknowledge the data, but also be caution around just some of the noisiness right now.
Yeah, I accept that caveat of, if didn't have the storms and hurricanes that we've seen, and also if we didn't have some of these strikes, would the labour market data be more robust than what it looks? So I think, as you say, they might ignore that one and see how next month's data pans out before making any changes. I guess as well, what we get with the labour data is things on wages. They're at 4%, so real wages still positive, and when we look at the GDP report, when we look at consumption, that was 3.7%. So we're still seeing the US consumer remaining robust.
Yeah, absolutely critical. And, I think it is a real positive, the US economy right now. It continues to drive global growth. The US consumer continues to spend. Interest rates are gradually coming down. Inflation appears to be relatively benign right now. Corporate earnings, they're delivering, but for those companies that have very rich valuations, are being tested a little bit, but on the whole, pretty positive for investors.
And I think it just really speaks to the point of remaining diversified.
Exactly.
Just to help navigate the volatility that we're seeing within markets. And also, next week we could see some further volatility from the US election and also what the Fed do. So we would really emphasise the importance of diversification over this period.
Excellent. Thank you, Matt. And that's everything from us today. Thank you all for watching. Have a great weekend, and we'll see you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.